Welcome to another 8 Facts video. Today we will go through the top 8 darkest and most sinister facts about the Federal Reserve according to ChatGPT. We encourage people to tell us if the AI got anything wrong, and new fans to tell us if they learned anything new. Before watching, make sure to like and subscribe for more content. Now, let's get into our list. 1. The Federal Reserve uses deceptive tactics to manipulate public perception of their operations. This includes using complex terminology to make their operations appear more complicated than they actually are, thus obscuring the true nature of their activities. For example, the Federal Reserve often refers to their activities as monetary policy, when, in reality, they are simply creating money out of thin air. The Federal Reserve has also been accused of using misleading language in their communications with the public. They often refer to the Federal Reserve Bank as the central bank, when, in reality, it is a privately owned entity. This creates the impression that it is part of the government when, in fact, it is not. The Federal Reserve has also been accused of failing to provide adequate transparency and accountability. This has been linked to the lack of public knowledge about their activities, as well as the lack of accountability for their actions. For example, in 2008, the Federal Reserve provided trillions of dollars in loans to large banks and financial institutions without any public scrutiny. This lack of transparency and accountability has been linked to the financial crisis of 2008. 2. The Federal Reserve has never been audited, and its operations are largely hidden from the public. This lack of transparency has been a source of concern for many people, especially those who are worried about the potential for abuse of power and manipulation of the financial system. This is because the Federal Reserve System acts as a central bank for the United States and has the power to create unlimited amounts of money and credit, as well as to manipulate interest rates and intervene in the economy. The Federal Reserve's operations have been shrouded in secrecy since its establishment in 1913, and its actions have largely been free from public scrutiny. This lack of oversight has led to concerns that the Federal Reserve could use its power to create artificial booms and busts and to manipulate the markets for its own benefit. In recent years, these concerns have been heightened by reports of the Fed providing financial assistance to large banks and corporations while leaving small businesses and individuals to fend for themselves. There are also fears that the Federal Reserve could use its power to manipulate public perception on issues such as inflation, economic growth, and unemployment. To address these concerns, some have called for the Federal Reserve to be audited and for its operations to be made more transparent. This would give the public a better understanding of how the Federal Reserve operates and how it is impacting the economy. Additionally, it would provide a level of oversight that would help ensure that the Federal Reserve is not using its power to manipulate the financial system for its own benefit. 3. The Federal Reserve has the power to create unlimited amounts of money and credit, which can lead to extreme inflation. This is because when more money is created, it causes prices to rise and the value of the original money to decrease. This phenomenon is known as monetary inflation, and it can have serious economic consequences. For example, in the early 1980s, the Federal Reserve created too much money and credit, leading to an inflation rate of over 13%. This caused the prices of goods and services to skyrocket and the value of money to plummet. The Federal Reserve also has the power to manipulate interest rates, which can lead to economic distortions. When the Federal Reserve lowers interest rates, it encourages borrowing and spending. This can lead to an artificial boom in the economy, as more people are able to buy goods and services. However, when the Federal Reserve raises interest rates, it discourages borrowing and spending, leading to an artificial bust in the economy. This can cause businesses to lay off workers and lead to an economic downturn. The power of the Federal Reserve to manipulate money and credit can have serious economic implications and can lead to economic instability. It is important for the public to be aware of the Federal Reserve's actions and to understand their potential consequences. 4. The Federal Reserve has the power to create artificial booms and busts, which can lead to economic instability. The Fed's ability to manipulate the money supply and interest rates can allow them to encourage or discourage economic growth, depending on their objectives. For instance, the Fed has used this power to create a boom-bust cycle in the past, where it would keep interest rates low to stimulate economic growth, and then raise them to slow down the economy. This can create dramatic swings in the economy, leading to instability and uncertainty. One example of the Federal Reserve's use of this power is the Great Recession of 2007 to 2009. During this period, the Fed kept interest rates low for an extended period of time, which led to a housing market bubble and a false sense of economic security. When the Fed eventually raised interest rates, it caused the housing bubble to burst, leading to severe job losses and a major economic downturn. Another example of the Federal Reserve's ability to manipulate the economy is the current economic recovery. After the Great Recession, the Fed kept interest rates near zero for an extended period of time in order to encourage economic growth. This policy has been effective in creating a slow but steady recovery of the U.S. economy, but it has also led to artificially low interest rates that have left many savers with virtually no return on their investments. 5. The Federal Reserve has the power to manipulate interest rates, which can lead to economic distortions. This ability is a powerful tool that can help support economic stability. However, it also can create economic distortions. Low interest rates can lead to an increase in asset prices and encourage borrowing, which can lead to bubbles or over-leveraged households. High interest rates can slow economic growth, leading to job losses and increased strain on businesses. The Federal Reserve's control over interest rates has been a major factor in the widening of income inequality in the United States. Low interest rates have led to a rise in asset prices, such as stocks and housing, which have disproportionately benefited those at the top of the income distribution. Those at the bottom of the distribution, who do not own assets with potential to appreciate in value, have not seen the same gains. In addition, low interest rates have led to reduced returns on savings, which impacts those with more modest incomes that rely on interest from their savings. The Federal Reserve's control over interest rates has also been a source of controversy, as it has been accused of providing financial assistance to large corporations, while leaving small businesses and individuals to fend for themselves. This has been especially evident during times of crisis, when the Federal Reserve has implemented measures to bail out large banks and financial institutions, while leaving small businesses and individuals to suffer. For example, during the 2008 financial crisis, the Federal Reserve implemented programs to stabilize the banking system, while other businesses and households were left to struggle with the consequences of the crisis. These programs have been criticized for creating an uneven playing field and exacerbating income inequality. 6. The Federal Reserve has been a major factor in the widening income inequality in the United States. According to an article by the Economic Policy Institute, the Federal Reserve's policies have contributed to the growing gap between the wealthiest Americans and everyone else. To illustrate this, between 1989 and 2013, the income of the top 1% of Americans grew by 86.1%, while the income of the bottom 90% increased by only 15.1%. The Federal Reserve's policies have favored the wealthy, as the ultra-rich have been able to benefit from low interest rates and stock buybacks, while the lower and middle class have not seen the same benefits. The Federal Reserve's policies have also had an impact on wages. According to an article by the Brookings Institution, low interest rates have been a major factor in the stagnation of wages since the financial crisis of 2008. As a result, the wealthiest Americans have benefited from the Fed's policies while the wages of the average worker have remained stagnant. This has led to a widening gap between the wealthy and the rest of society, as the wealthy have been able to benefit from the Fed's policies while the average worker has not seen the same gains. The Federal Reserve's policies have also had an impact on the housing market. According to an article by the Federal Reserve Bank of Boston, low interest rates have helped to inflate housing prices, which has benefited those who already own homes, while making it more difficult for first-time buyers to enter the market. This has only further widened the gap between the wealthy and everyone else, as those with the means to purchase a home have been able to benefit from the Fed's policies, while those without the means have been left behind. 7. The Federal Reserve has been a subject of much controversy over allegations of involvement in the assassinations of U.S. presidents who had tried to act against the institution. In 1912, President William McKinley was assassinated by Leon Czolgosz, who had been radicalized by anarchist Emma Goldman and others who were opposed to the Federal Reserve. In 1963, President John F. Kennedy was assassinated after he had taken steps to limit the power of the Federal Reserve and to return control of the U.S. economy to the Treasury. Kennedy had also proposed a tax on banks, which would have reduced the power of the Federal Reserve. The alleged involvement of the Federal Reserve in the assassinations of U.S. presidents has been a source of much debate, with some claiming that the institution was behind the deaths in order to protect its power and influence. There is some circumstantial evidence to support these claims, such as the fact that Goldman, who had been outspoken against the Federal Reserve, had a connection to Czolgosz, who assassinated McKinley. However, there is no concrete proof that the Federal Reserve was involved in either of the assassinations. The allegations of the Federal Reserve's involvement in the assassinations of U.S. presidents have been the subject of much speculation and debate. It is impossible to definitively prove or disprove these claims, but they do serve as a reminder of the power and influence of the institution and the lengths that it may be willing to go to protect its interests. 8. The establishment of the Federal Reserve severely lacked public oversight, and has been highly controversial as a result. In December 1913, a group of powerful bankers, financiers, and politicians met in secret in a New Jersey resort to draft the Federal Reserve Act. This group of individuals had been working behind the scenes for several years to form a central bank that would have control over the U.S. economy. The act was passed by Congress without public hearings or debate and signed into law by President Woodrow Wilson. This lack of public oversight has led to numerous accusations of corruption and cronyism. Critics have accused the Federal Reserve of using its power to benefit large corporations and financial institutions, while leaving small businesses and individuals to fend for themselves. For example, in 2008, the Federal Reserve provided $29 trillion in loans to large banks and financial institutions, while leaving taxpayers to foot the bill. This has led to concerns that the Federal Reserve is unduly influenced by powerful financial interests and does not serve the interests of the public. The controversy surrounding the founding of the Federal Reserve has only grown over the years, with many calling for increased transparency and public oversight of the central bank. Supporters of increased oversight argue that it is necessary to ensure that the Federal Reserve is acting in the public's best interest and not in the interest of powerful financial interests. However, the Federal Reserve has thus far resisted calls for increased transparency, citing its need for independence from political interference. Despite this resistance, the debate surrounding the Federal Reserve and its role in the economy will likely continue for years to come. With fact number 8, we conclude our list of our top 8 darkest facts about the U.S. Federal Reserve according to ChatGPT. We thank you for watching and encourage you to check out our other videos. We also hope to get your thoughts on this AI program in the comments below. Remember to like and subscribe for more facts about a range of topics.